Hi guys, I'm back here on my YouTube channel, and today in video number 8 we're going to talk about how you avoid that the stock market will get under your skin and that you can have a good night's sleep even though you're fully invested in the stock market. I have 5 good advice or recommendations on how you can avoid letting the stock market get you, and I think it's a quite common thing, and you will experience throughout your period and years on the stock market that there will be periods, especially in bear markets, in negative developing markets, especially during panic crisis as we had in 2000, 2001 with the IT bubble, 2007, 2008 with the financial crisis, and most recently last year with the COVID-19 and the extreme accelerated negative downwards trajectory we had in February and March. So there will be times where it is obviously more difficult to actually be able to balance whether or not it affects you, but I will give you 5 good recommendations on how you can actually get to a point in your investing where it will be at least less influencing and impacting on your daily life, your mood, how you're sleeping at night, so on and so forth. Because whenever it's something regarding economics, your financials, personal finance, it becomes extremely sensitive, because often and lots of articles and research shows that your personal finance are influencing your mood and your everyday life. So starting with number 1, never invest more than you're prepared to lose. So what I would recommend is actually to set up some sort of governance on how you are going to approach the market. And I think we've been talking about strategy quite a few times now, and I want to say that strategy starts with sort of telling yourself and having a sit down with yourself, reflecting upon what are the number of or what is the amount of money you want to invest in the market. Is it something you're going to do continuously over a period of time? So for instance, putting in 5,000, 10,000 kroner or even dollars if you're more wealthy in the market on a monthly basis. How many percentages is that of your financial situation, so of your salary every month after taxes? How large a share of that money you have left after you have paid all your expenses and paid to the tax guys? How much of that will you invest into the market? I think that is at least a good way of approaching it. And then in terms of never investing more than you are prepared to lose, you shouldn't have a too significant allocation of your personal finance into the market, first of all, because you need to be able to live and also live your life as if nothing happened tomorrow. If you lost your day job, if there came a crisis in the market and we were going to be in a bear market for a couple of years, it's important that you're able to live your everyday life. Also, of course, if you are more risky than the average investor, then you need to be aware and prepared to lose more than the average investor. So the stock market is growing by 7% annually. That is historically shown over the last 200 years. So if you're investing in a ETF or an index fund that is simply following the MSCI World, then you should be prepared to gain 7% annually over the next 20, 30, 40 years. However, if you're going to stock pick, if you're going to go into segments and corners of the market such as small cap, junior minor, so on and so forth, some of the companies I'm also investing in, then you need to be aware and prepared to lose more than the average investor. Then there's something regarding the second advice, that is risk manage. You should always risk manage your positions, and what I mean by that is never go all in one company, never go all in one sector. Myself is sort of I'm an investor that likes to follow macroeconomic tendencies as well, and also sort of overall trends in the market. That means that, for instance, right now I think we will have an economy that will be under a significant pressure. At least the public debt will only grow over the next couple of years with stimulus, QE programs, and so on and so forth. That will be good for metals relative to the dollar. So right now I have an overweight in my portfolio towards mining and metals. And again, that's my decision. So never go all in. That's at least my recommendation. Never go all in a company. Never go all in an industry. Then there's leverage, and I think this is a question I see flourish all over the internet, on all social media. Should I borrow money to invest in the stock market? I see some people that are doing that. I think it's extremely risky, also because all of a sudden you are prepared, in the sense that you need to be prepared to lose all of the money you put in the stock market. You're prepared to lose more than you actually have on your books. I think if you are a proven investor with a good track record, there may be some sense in leveraging and putting some margin in the market. However, I think it is extremely risky and it's not for everybody. So I would never recommend to borrow money to go into the stock market. And then the last thing regarding risk management is options. So another way of leveraging your positions is to invest in options that provides you with gearing, or even is sort of, it could be perceived as a bet. So options often function in that way, that you're investing in a company and you're investing in a price target within a certain period of time. So for instance, Tesla, if you expect it to reach $1,000 by end of February, then you can probably buy an option that is sort of have an expiry at that point in time. And if it doesn't reach the 1,000, then you will likely have a significant loss, maybe even 99% of your capital. So options is also a way of leveraging and putting some gearing on your positions. And again, that is a matter of risk management. The third advice is to diversify. I think diversification, also as mentioned during the risk management, is extremely important, and sort of diversifying yourself across different markets in terms of geography, but also across different industries and sectors is extremely healthy, and it will provide you with a security that is extremely healthy to have in the market. Have some money in cyclical stocks, have some money in defensive stocks, have some in growth stocks, have some money in finance, have some in pharma, have some in tech, have some in green energy, so on and so forth. So a healthy diversification, of course, this will vary with the amount of capital you have allocated in the market, because as always, you need to have considered what fees will have of an impact on your portfolio, because if you only have a limited amount of money available, then the greater diversification you put into the market will also mean that you will be invested in more companies, more sectors, and that ultimately means that you need more or you will pay more fees. So if you have a limited capital allocated to the market, then you may want to consider whether diversification to a great extent is not necessarily the best way of approaching it. The fourth advice from my side is to analyze and do due diligence. As we've also talked about in some of the previous videos, if you are simply following people blindly based on advice, and if you're following people blindly in terms of what they're posting on their social media, then you are definitely basically going to the roulette table and just closing your eyes and then hoping for the best. And that is definitely not the best way of approaching the stock market. You are also closing your eyes if you're simply buying into indices and ETFs. However, you are buying blindly into something that over a significant time period has shown to be efficient. So in my perspective, if you are just following some random guy like myself on Twitter blindly and simply copy trading, then you need to be aware of that risk you put into your own capital allocation by doing so. So in other words, if you're doing your own due diligence and if you're analyzing companies, sectors, industries, the market yourself all the time, and you're sort of applying that analysis and due diligence into companies and positions you have in your portfolio, all of a sudden you have your own responsibility and your own competencies put down over your portfolio, and that will just create a so much more healthier dynamic in your portfolio, and you can sleep well at night because all of your capital invested in the stock market is not based on somebody else's competencies, somebody else's eyes, and somebody else's analysis and due diligence. So a good advice to also feel well and sleep well at the night with the money in the stock market: do your own analysis and due diligence. And remember, the more you follow other people, the more the stock market will simply be a bet on somebody else, and then it will simply become a casino, and you shouldn't perceive the stock market as a casino. The last and probably most difficult recommendation, because it's not something I do myself, I'm at least not very good at it. You shouldn't monitor your portfolio several times a day. If you're investing in the stock market for the long haul, then you need to understand that the daily fluctuations in the market is not something that is important for your portfolio or your overall wealth. If you're investing in companies for the long haul, and if you're stock picking, diversifying yourself across several industries, then the only thing you actually need to, of course, apart from always being monitoring the market overall in terms of what are the trends, what are the changes, for instance, Joe Biden becoming president, how will that influence my portfolio? But what is most importantly is that you follow up on your companies on a quarterly basis whenever they're releasing their quarterly reports, because that is where you can see whether the companies you're investing in is actually healthy companies and if they're following the trajectory that you bought into. So again, you don't necessarily have to look at your portfolio every day. I like to do it because I also trade a bit more often that maybe the most rational thing to do when you're a long-term investor, but I also like to do some short-term trades every now and again. So, but it will remove a great hassle from your mindset if you're sort of removing that from your equation in terms of not really being affected by the daily fluctuations. And I have, for instance, my own personal portfolio, the one, so as you know, I'm managing several portfolios, but my own portfolio, I think I'm only looking at that, I'm only locking into that account maybe once a week, and I think just my own personal finances, I'm actually not that fearful or sort of concerned regarding, because I know they're positioned in a good place, and they're positioned in something that I can sleep well at night with. So to summarize, I think, of course, never invest more money than you are prepared to lose. And that also means that if you need the money within a short time horizon, for instance, if you want to buy a house within the next 6 or 12 months, then you shouldn't invest in the stock market, because you can never predict what will happen in a short-term period of time on the stock market. Second, risk manage. Don't over leverage yourself if you're not sort of comfortable with it, as well as don't go all in specific companies or specific industries unless you're certain regarding it and if your capital allows for it. Meaning that if you have a small portion of money, then it may make sense to actually start off with a few companies in a couple of sectors, and then sort of growing the portfolio as your wealth also grows. Third, always diversify. It just creates a better dynamic, and if cyclical or passive stocks are in a growth trend over the next year, then it won't really benefit you if you're only positioned in growth stocks, for instance. So diversify yourself. It just creates a greater dynamic in your portfolio. Then analyze and do your own due diligence. It's so much more comfortable that if your own perspective on the market is also agreeing with whatever you're investing in, then you can sort of be true to yourself, and also it will not be your investing in somebody else's competencies and insights. It will be you investing in your own insights and your own perspectives on the market. And then lastly, don't monitor your portfolio daily. I know it's difficult, but it will reduce your mental capacity and your mental equity in the market, because if you're not following it daily, you can't really be affected to it. By the end of the day, we need to live our lives to the greatest possible extent, and I mean that in the best sense, because of course we want to grow our wealth and we want to grow our portfolio over time, and it will do so if you're investing wisely. However, if you are sort of growing your wealth at the risk or at the loss of your great mood and your sort of your everyday behavior up until that means when you're going to work, when you're home with your family or whatever. You should never lose those things just because of the stock market. And I can say that because I have felt it on my own body. Every time the stock market goes down, your behavior and your mood is also is also going down. So have that in mind, and then hopefully these 5 advice will help you in not letting the stock market get under your skin. See you next time. Bye guys.